Imagine for a moment you're at the helm of a global company, navigating today's incredibly dynamic and, well, constantly shifting market. How do you steer through those unexpected challenges, from brand new regulations to evolving trade policies, all while still trying to drive growth and keep innovation front and center? Well, this deep dive is all about how one company, Revvity, is doing precisely that. We're going to unpack their recent second quarter 2025 financial results. We'll focus on the key performance indicators, the hurdles they faced, and their strategic responses to maintain momentum. Think of it as a real masterclass in corporate resilience and agile leadership.
Right.
And our insights, they come directly from Revvity's Q2 2025 earnings conference call and their official press release. We'll be extracting the most important nuggets of knowledge to give you a clear, concise picture. Okay, let's dig into this then. The second quarter of 2025 presented a really dynamic macro and market environment for Revvity,
Yeah, it certainly did.
throwing persistent and even some new challenges their way. Yet despite all of that, they reported a strong overall performance.
That's right. Revvity achieved $720 million in revenue for Q2 2025, which translates to a solid 3% organic growth overall. Their adjusted EPS came in at $1.18,
Okay.
which was actually solidly above their own expectations and guidance. According to the CEO, this robust performance, well, it exemplifies the inherent balance and strength provided by their unique blend of businesses.
So it sounds like this wasn't just a matter of, favorable conditions. It really speaks to a deep-seated adaptability.
I think that's fair to say.
What were some of the key actions that demonstrated this agility, especially in the face of those challenges?
Well, management specifically highlighted their ability to maneuver rapidly in varying tariff environments. That was one.
Okay.
Their strong levels of innovation, too, and their swift management of the cost structure. For instance, they took proactive steps, like strategically building inventories ahead of anticipated tariff increases.
Ah, right. Planning ahead.
Exactly. Demonstrating a sharp awareness of global trade shifts and, agile supply chain management. These efforts ultimately led to Revvity generating really strong cash flow.
And looking at their cash flow, there's a particularly significant detail there, isn't there?
There is.
They generated $115 million in free cash flow in the quarter.
Mm-hmm.
And they managed that even while, as you mentioned, strategically increasing inventories ahead of potential tariff changes.
Yes, which is quite a feat.
This pushed their year-to-date free cash flow conversion to adjusted net income to an impressive 90%.
90%.
Now, for anyone unfamiliar, free cash flow conversion basically measures how much of a company's profit actually turns into cash that it can use.
Right. Usable cash.
Achieving 90% is a powerful indicator of financial health and efficiency, totally in line with their long-term aspirations.
Exactly. And that strong cash flow wasn't just sitting idle either.
No.
It fueled aggressive share repurchase activities. After repurchasing $150 million in Q1, they bought back nearly $300 million more in Q2 alone.
Wow, quite an acceleration.
Yeah, bringing the first half total to almost $450 million. This significantly reduced total shares outstanding by over 4 million, nearly 4% in Q2. And that's a notable 6% decline since Q2 last year. So it clearly shows a strong return of capital directly to shareholders.
That's a clear signal of confidence in their own value, I'd say.
Mm-hmm.
And on that note, despite actively evaluating potential M&A targets,
Yes, I mentioned that.
their disciplined multi-criteria process hasn't yet identified targets compelling enough from a financial profile and expected return perspective.
So they're being picky.
Seems like it. They remain disciplined, believing Revvity is, and this is a quote, truly special on its own.
Interesting phrasing.
Okay, so we've explored Revvity's overall financial strength and resilience. Let's now break down how their individual business segments contributed. Maybe starting with Life Sciences.
Sure. The Life Sciences business grew 4% organically,
4%. Okay.
generating $366 million in revenue for the quarter.
And wasn't there a standout performer within Life Sciences, their software franchise, Signals?
Absolutely. The Signals software franchise truly led the charge there. It had approximately 30% organic growth.
30%. That's huge for software.
It is, and it set a new record for orders in a single quarter. It showed remarkable strength across several key metrics, too, like a 21% ARR uplift.
Meaning more revenue from existing customers?
Exactly. Annual recurring revenue growing significantly. Then 115% net retention.
So customers are staying and spending more.
Precisely. A powerful sign of product value and, stickiness.
Yeah.
And 13% APV growth. Plus, nearly a third of the business is now SaaS, software as a service.
More predictable revenue.
Right. And this strong software performance specifically helped drive mid-single-digit growth with pharma and biotech customers. That was actually an improvement from Q1.
So this strong software performance is clearly a strategic win. What does it tell us about Revvity's broader strategy, maybe especially when considering other parts of life sciences?
It absolutely highlights successful, targeted investments in innovation, no doubt. While the life sciences solutions business overall did see declines in instrumentation sales.
Okay, so not everything was up.
No. But this was partially offset by that continued robust growth in reagents. Reagents have now shown 5 consecutive quarters of growth, particularly with pharma and biotech customers. It really underscores the strong demand for these consumable products that support ongoing research and development.
However, not all customer segments were as strong as those, right? You mentioned academic and government.
That's correct. Sales into academic and government customers globally declined in the low single digits.
Similar to Q1 then.
Very similar trend to Q1, yes. And the company assumes these headwinds will probably continue for the foreseeable future.
Okay, so while life sciences demonstrated robust growth, Revvity's diagnostics segment navigated a different set of market dynamics, particularly in China, I understand. Let's shift our focus there.
Right. Diagnostics grew 2% organically overall, generating $354 million in revenue. Their immunodiagnostics franchise grew in the low single digits, but it was facing more difficult multi-year comparisons.
Okay, low single digits. But diving deeper into diagnostics, it faced a new and unexpected challenge midway through Q2, specifically in China.
Yes, that's a key point from the quarter.
Could you elaborate on what that challenge was?
Sure. Around midway through Q2, Revvity began facing headwinds in China related to an expansion and acceleration of a hospital lab reimbursement change known as diagnosis-related groups, or DRG.
DRG, okay. How does that work?
Well, to put it simply, the DRG system bundles payments for hospital services. So it shifts the financial incentive away from just the sheer volume of tests performed towards the overall value and efficiency of care. This expanded policy led to an initial reduction in overall volumes for some of their multiplex products.
Multiplex, those are the tests looking for multiple things at once.
Exactly. Tests that look for multiple targets in a single sample. They're often more cost-efficient for labs in a volume-driven system.
Right, so the incentive changed. That sounds like a significant shift in the market over there.
It is.
What's the anticipated long-term impact of this DRG policy on Revvity's business in China?
Well, it's interesting. While initially reducing volumes for those multiplex products, the company actually believes this policy is likely to eventually drive an increase in volume for more expensive singleplex tests.
Singleplex testing for just one target.
Correct, which they also offer. However, for the remainder of this year, they do expect a meaningful pullback in their China immunodiagnostics business.
Okay. So if this policy is creating such a specific headwind, I mean, what does this all mean for Revvity's big picture financial outlook for the year?
Well, the China immunodiagnostics business, which makes up about 6% of total company revenue.
Only 6%. Okay.
Yes, about 6%. It's now expected to be down high teens for the full year.
High teens down. That's quite specific.
It is. And this specific headwind is driving the entirety of the change in the company's overall outlook for 2025.
Right. Despite such a concentrated and significant new challenge, though, the overall impact on the company's outlook is described as modest.
Modest.
How are they managing to mitigate such a focused headwind? Is it strength elsewhere?
It's a combination of things. Their ability to deliver solid results in other areas, yes, combined with very tight expense management and immediate actions like right-sizing their business operations in China.
Okay, taking direct action there.
Right. Those steps are helping to cushion the impact. And it's worth noting, outside of China, the immunodiagnostics business performed very well.
Oh, really? Where?
Particularly in the Americas, saw mid-teens organic growth there. And Europe was solid too, mid-single digits.
Okay, so strong performance offsetting the China issue.
To a degree, yes. Also, their reproductive health business grew low single digits. Newborn screening performed strongly globally, despite those, continued headwinds from lower global birth rates.
Got it. So, given all these developments, the strengths, the new challenges like DRG, what's the updated financial outlook for the full year 2025?
Okay, so Revvity now expects full-year organic growth to be in the 2% to 4% range.
2 to 4%, that's down slightly.
Yes, it's down 1% from their prior outlook.
Okay, and EPS?
Adjusted EPS for the year is expected in the range of $4.85 to $4.95.
Also down a bit.
Also a modest 1% reduction, yeah. Total revenue for the year is now projected between $2.84 billion and $2.88 billion.
And I think you mentioned currency playing a role too, the weakening dollar.
Yes, that's shifted. Foreign exchange is now anticipated to be approximately a 1% tailwind to revenue for the full year.
A tailwind, so helping them slightly.
Exactly. It's a notable shift from previous assumptions, which had actually projected a slight headwind from FX.
What's particularly striking here, though, is how aggressively they seem to be managing costs in response to these new pressures, especially given that DRG impact in China. This sounds like a key part of their resilience strategy we talked about.
It absolutely is. They are implementing near-term cost actions, but also beginning structural actions.
Structural, meaning longer term.
Yes, those will take until 2026 to be fully implemented. These aren't just minor tweaks. They're designed to fundamentally offset margin pressures. The aim is for a 28% operating margin baseline by next year.
28%.
Yeah, which implies they're expecting greater margin expansion than typically seen in a given year. It shows a very proactive approach to profitability in, well, a challenging environment.
Definitely proactive. Okay, beyond the numbers and cost management, what about innovation? Are they still driving new solutions?
Oh, absolutely. Innovation remains central. Revvity launched the new IDS i20 analytical random access platform.
IDS i20, what's that?
It's through its Euroimmun business, launched in May. It's CE marked and FDA listed. It represents a pretty significant breakthrough in special testing automation.
How so?
It allows labs to consolidate up to 20 analytes across 6 different diagnostic specialties, all on a single instrument.
Wow, okay. More consolidation.
And it processes up to 140 tests per hour. So for a lab manager, this means significantly less manual work, faster results, and a more streamlined operation.
Sounds like exactly what labs need today: efficiency, cost effectiveness.
Precisely. It's a direct answer to that demand.
Yeah.
And furthermore, their reproductive health business is benefiting from the ramp-up of sequencing volumes starting in July.
Oh, is that related to a specific project?
Yes. As part of the Genomics England Generation Study contract, that's expected to contribute around $10 million in the back half of the year, mostly in Q4.
Okay, so new revenue streams kicking in.
Mm-hmm.
And it's not just about financial performance or new products, is it? There's a broader picture of corporate responsibility here too, right? ESG.
Absolutely. That was another highlight. Revvity's continuous improvement in sustainability, governance, and social priorities was recognized by MSCI. They increased their overall ESG rating to AAA.
AAA, that's their highest level.
It is, yes. It signifies their strong commitment and performance across environmental, social, and governance factors. It really demonstrates a holistic approach to their business.
So reflecting on all this, what have we learned from Revvity's Q2 deep dive? I mean, it feels like a compelling story of a company navigating some significant and sometimes unforeseen global economic and regulatory headwinds.
Yeah, I think that sums it up well.
They've shown incredible resilience, adapting quickly through strategic cost management, innovation, and that disciplined capital allocation. It really feels like that masterclass in corporate agility we mentioned at the start.
Indeed. Their ability to deliver solid financial results, launch cutting-edge products like that IDS i20,
Right.
and strategically repurchase shares, all while facing serious challenges like China's DRG policy and those evolving tariffs.
Yeah.
It truly underscores the strength and adaptability of their transformed business model.
It definitely does. Which leads us to, I guess, a final thought for you, the listener. In an era where disruption seems to be the new normal, Revvity's story really showcases the critical importance of having a flexible strategy and adaptable teams. So how might their focus on resilience and that proactive cost management, even amidst really unexpected shifts, inspire your own approach? How might it influence how you navigate uncertainty in whatever field you're in, whether it's your business, your team, or even, your personal projects? Something to think about.